Today we're going to do something a little different. We're going to talk about CEOs. We're going to talk about why some CEOs are good, why some CEOs are terrible, and what lessons we can learn from that. And we're going to name names. Today I have three guests. Glenn Shore of Evercore ISI, Gerard Cassidy of Royal Bank of Canada, and Dwight Collins of Autonomous.
It's a near impossible job given the size and complexity of the companies we cover. You have to be great at a lot of things.
It has to be discipline. Not only do you surround yourself with great people, you have to be a disciplined CEO, sticking to the strategy and the goals you've set out.
To me, the best CEO in financials has been Jamie Dimon.
He really kind of combines every trait you're looking for.
And that's not by coincidence, because the culture that he brings, they execute like ninjas, right?
One of my favorites is Vlad Tenev of Robinhood.
James Gorman deserves to be on the leaderboard.
We went from the good, and we're going to go to the bad, and then we're going to do everything in the middle. Give me a bad. What turned out to be wrong at Schwab? My Hall of Fame of bad CEOs, Ken Lewis of B of A. Bank of America did maybe two of the worst acquisitions in the history of mankind.
850 people dial into our conference call, and the operator goes, "Our first question is coming from Steve Eisman from Front Point." And he's like, "Yeah, I have a question. I did more due diligence on the underwear I'm wearing today than B of A did on Merrill Lynch."
If I could take away some of the lessons that those people have in common is that Hi, this is Steve Eisman, and welcome to another episode of the Real Eisman Playbook. And today we're going to do something a little different. Usually I interview one guest, and today I have three guests. So before we even discuss what the topic is, let me introduce them. Glenn Shore of Evercore ISI, Gerard Cassidy of Royal Bank of Canada, and Dwight Collins of Autonomous. So before we even start, why don't each of you guys just tell us what you do? Glenn, you go.
What I do, I am a sell-side equity analyst for the last 27, 28 years, covering the same big group of companies, big large cap banks, brokers, traditional asset managers, the trust banks, and all the private markets asset managers.
Similar to Glenn, I'm a sell-side analyst as well. Been a sell-side analyst for over 34 years, covering the top 20 banks over this time period. Been through a few cycles.
Just a few.
Just a few, and gained some insights from the mistakes we've made. The most challenging time was when the Texas banks all blew up in the 1980s, and we all learned some very hard lessons. But it's been a great run.
And Dwight?
The co-head of Autonomous US, and I run our institutional equity sales desk in the US. Guys, good to see you as well. It's been quite some time.
Yes, it has.
And Steve, we've all decided we are going to file a workers' comp claim against you for making us come over here when it's 1 billion degrees outside. So I think it's the
file away.
Hottest day since the 1800s or something like that.
Something like that. It's brutal out today. Yeah. So the topic du jour is we're going to talk about CEOs. So we're going to talk about why some CEOs are good, why some CEOs are terrible, and what lessons we can learn from that. So let's just go around the horn and talk, and we're going to name names. So Glenn, you go first. Let's start with the good. Let's be non-controversial. Let's start with the good. What do the good CEOs have in common? Like, what are the lessons here?
So first of all, it's a near impossible job given the size and complexity of the companies we cover. But it is what it is. We all put report cards on them, so I'll answer that question. You have to be great at a lot of things, right? You have to build a team around you and give them enough room to grow and be great managers on their own, yet hold them accountable and have reasonable goals that you communicate out to the world. And so there's pressure to perform. And it's not just setting strategy and getting your managers out there. It's somehow mobilizing the company around that, right? There's lots of companies that might have all the same theoretical strategy, but only some execute on it. It's surrounding yourself with great people. It's listening to honest feedback, giving yourself a fair report card, holding people accountable, and making tough moves. I don't know. And then it's seeing around corners. It's some of the examples that we're going to talk about later are some were fat and happy and lazy and counted their blessings, and some never stood still and constantly invested for the future. And I think I have some great examples to talk about that. So that's just a smidgen of the things that make a great company a great CEO.
Gerard, you're the old man here.
Yeah, that's
You've
right,
seen
I am.
more than most
Yep.
of us.
No,
Give us some lessons.
Yeah, no, Glenn said it well. And I would add to that there has to be discipline. Not only do you surround yourself with great people, you have to be a disciplined CEO, sticking to the strategy and the goals you've set out. And on top of that, you've got to be able to take constructive criticism, which is not that easy to do. So when you look at some of the really good CEOs over the years, is that, yes, they've got a great team, they've got a strategy, but they also can take some constructive criticism. I'd also point out, you've got to create...
Maybe sometimes constructive criticism from people like us.
Yes, absolutely. And they may not take it as constructive, but it's...
Over the years, Mayo and Jamie Dimon have gone toe-to-toe at times.
Yeah, and though Ed Crutchfield is no longer with us, him and Tom Brown would go
Yes,
at
they
it,
would go toe-to-toe.
toe-to-toe
And
as
Steve
well.
and everybody else.
Very true. Very
Dwight,
true.
your coverage is a little bit broader
Yeah.
than these guys. You do all the financials. So give us some thoughts here.
My father had been in the military, and he always said the best officers were the ones who delegate but verify. And I think that's probably the same
Ooh,
for,
I like that.
for CEOs. The other thing I would say is what makes a good CEO or a management team, ones that don't hide, right? Ones that are out there constantly on the road, who are willing to meet with not only their shareholders, but also with those who maybe are kind of betting against the stock or more negative on it, or sell-side analysts who haven't underperformed. And it goes back to your point around, willing to hear kind of the hard truths, the criticisms, and don't hide from it.
In fact, if I could just jump in, because
Jump away.
Dwight said something very interesting. Back in the old days, Steve, when we had fax machines, it used to be that the fax machines didn't send all the faxes out at the same time. There was a queue. And so we put a sell recommendation on a bank called Fleet Financial back in 1989, which was everybody's favorite. And to your
They were
point,
based in Boston.
They were, yes, well, Providence, Rhode Island, but
okay.
eventually it became Boston. But to Dwight's point, what was so interesting is when we put the sell recommendation on, and you don't get many sell recommendations from the sell side, especially back in that era. And so they called me up and they said, you know what? We don't agree with it, and we're going to prove you wrong, and we're going to put you at the front of the fax line now for the earnings releases. Lo and behold, I got lucky. The stock crashed and burned.
But they didn't hide.
They didn't hide. But Dwight, they didn't hide. And to this day, and that's a long time ago, to this day, Jack Flynn, Terry Murray, I've never forgotten it.
Delegate and verify is very interesting because the things that reminds me in this case is we've been in the room with certain CEOs and they know every number and they know every risk
Some
that there is.
CEOs.
Some. And we've been in the room with ones that go like this a lot because they have their CFO next to them and they don't know any numbers. And eventually that ends with some tears.
All right, so Glenn, give us some more details. Like, let's name some names. I mean, to me, the best CEO in financials has been Jamie Dimon.
It's almost not fair.
It's actually, you're right. It's
we have to
not
start with,
fair.
okay, here's Jamie, and now let's talk.
And by the way, because we all go back so far, I mean, people don't realize. So for those of you out there who don't know, Jamie Dimon was Sandy Weill's right-hand man.
Correct.
And they had a falling out, and he was basically on the beach for a couple of years.
Absolutely.
And then
Fired.
And then he became the CEO of Bank One.
Correct.
Which was a crappy big bank. And he fixed that. And then he merged with JP Morgan, which had a great name, but was a crappy bank. And he fixed that. And then he joined it with Chase, which was also a crappy bank. And he fixed that too. It's pretty extraordinary. So let's talk about Jamie, because he's so cut above everybody else in that way. Although I have a couple of other ones who I think are close. What have you learned from watching him over these years?
The level of accountability and transparency that he shines on his business and his management team is shocking. I mean,
what do you mean shocking?
It's shocking how accountable they hold themselves. They say, here's what we've done the last couple of years. Here's what we're going to do this year. This in terms of top line growth, expense management, managing credit, different volume trends, and return on equity. And then the next year they have their investor day and say, we did it here, we didn't do it here. And he puts his people out there in a chance to perform and succeed. He develops leaders. How many CEOs of other financial institutions around the world right this second are descendants from the Jamie family tree?
No, it's CEO of Wells Fargo, for example.
I mean, there's a lot, right? So, and that's not by coincidence, because the culture that he brings, they execute like ninjas, right? They because not only are they the biggest and get their scale benefits, but they're constantly investing for the future, and they don't get everything right, but man, they get a lot right. How is it that the biggest bank in the country can take share in every single business they're in?
The other thing about him, you don't get the sense when you're at the investor day that there's real arrogance there. There's confidence, but not arrogance. And he's always saying, as his senior management team, they're always looking over their shoulder. They don't take it for granted of who they are. So they're always working. But the other thing that he has done so well was, you think of the acquisitions that he has done, the last 3 acquisitions, government assisted, Washington Mutual, First Republic. Bear Stearns wasn't government assisted, but it essentially was sent from the
It was government assisted, but the assistant was eventually withdrawn.
Yeah, there you go. But those deals, what we've learned in our careers is banks that buy failed institutions from the U.S. government get the best deals. And his last 3 deals have really put him over the top, in addition to the excellence.
But how do you get there? You create your own luck by managing risk and having, in Jamie's famous words, a fortress balance sheet to be there to make sure.
When times are bad.
Yeah.
Oh, yeah.
You got any comments on this, Dwight?
He really kind of combines every trait you're looking for, right? He's a field general. He's someone who, obviously, to your point, really has developed an amazing team around him. He's open. He's honest. You know, we've all heard all of his sound bites, right? He kind of says it as he sees it. He also is aggressive. That's how he gets a lot of these deals, right? Where he's been on the front foot. And so you put it all together, and he just really has had the perfect package. Kind of reminds me, I mean, for a lot of the listeners, right? I mean, everyone, for the most part, watches and loves sports. It's kind of like the Belichick era of the Patriots, right? He had this amazing regime around him. Belichick was always aggressive, one of the first to always kind of go for it on 4th down. Took those gambles, often paid off, and had this dynasty. And it's similar to Jamie Dimon.
One last critical quality, and this goes for every good CEO, but Jamie does it big time, is, these are public companies, right? We all grill them at different times about this expense of that, and then there's cyclical things happen, like markets go down. He comes as close to it as it gets to managing the company for the long run, like a private company manager. He tells his managers, don't come to me and tell me you didn't have money to invest. If there's something that's important to the business, you invest, and we'll figure a way to pay for it. And sometimes he just ups his expenses by $6 billion, and the stock still goes up because people know it's going to be the right investment.
Because they trust him at this point.
100%.
Okay, so he's in the Hall of Fame. He's numero uno.
Yes.
That's easy. Okay, so let's go around the horn. In the years that you've watched financial services, who's number 2? And who's number 3? Go ahead.
I came with the big 5.
Okay, we'll go.
You just want one? We're going to tease it out?
Give me 2.
Okay. James Gorman deserves to be on the leaderboard.
Yeah, I like that.
He had to manage. First of all, he took over a not so well managed company that was over their skis on part of the investment bank.
James Gorman, for those, became CEO of Morgan Stanley, basically as the crisis was ending.
Yeah.
But the entire paradigm of how much capital you need and how you could manage the company was being dictated by the feds, and the industry has gone through wrenching changes, and he became CEO. Go.
And he was the theoretical consultant that was going to screw up one of the best investment banks and a good wealth management business, and he did nothing but make it a lot better. He fixed part of the trading in the fixed income businesses that were a little extended, and in wealth management, again, you create your own luck, but they feasted on Citi's problems and took in Salman Smith Barney. And then they made a series of acquisitions to beef that up. It's now the biggest, the broadest, the fastest growing, the most profitable. And that is a forever business. And it changed the business composition the mix, the makeup, and the stock went from being an 8 or 9 multiple company to a 14 multiple company, rightfully so,
I think we
because
all agree on
profitability
James
improves.
Gorman. Who's your next one?
I have 3. I'm going to have to pick from one of them.
Name them all.
Okay. Steve Schwarzman of Blackstone.
Okay.
The vision and what he's created in this private markets, and then the chutzpah to go when everybody said, why would you ever want to take retail money, to build out the biggest wealth platform, and is now delivering private markets products to the wealth channel. And that is a huge opportunity. Larry Fink at BlackRock, stepping up to the plate when they were a fixed income only manager in a world that was equities were starting to grow, and bought Malim from Merrill, an equity manager, and went through that consolidation that nobody wanted to do. Paid, I think it was like 19 plus times trailing 12 months earnings right at the crisis for BGI.
What was BGI?
At the time, no one knew. Today, you call it iShares and the biggest ETF business on the planet.
So he bought the index business.
Before the big switch from active to passive,
right?
Had the money and the vision to go around that.
He's the only traditional asset manager who's really made it through, given all the wrenching changes that have taken place.
Yeah. And so constantly investing in the future and in the customer's needs as they evolved. And he's doing it again right now. They just plopped down $25 billion to buy an infrastructure manager and a private credit manager at high multiples. And so he's in the process of reinventing again and augmenting the company. And then the last one is Mark Rowan at Apollo. People were like, what are you doing? You're creating an insurance company. You're buying it onto your balance sheet. Insurance companies trade at 7 times earnings. Like, they gave that company so much heat. And he turns around what was a very, very tough culture. And when he took over, he bought an insurance company and he created just a completely different culture. It's shocking on the changes that those companies have made, those CEOs very specifically.
If I could take away some of the lessons that those people have in common, is that they're willing to go against the grain and do things that they will get severely criticized for.
Yeah.
Sticking just with banks, and Dwight knows.
Well,
this.
that's what you know.
No, correct. I'm not in the old asset world that Glenn is, but Dwight will relate to this one, which is Bob Wilmers of M&T Bank.
Yes,
unbelievable, and his.
So M&T Bank, is for those you know, is what you'd call a bank, a very traditional bank that basically has grown up in. I mean, you know this bank very well because your dad worked there.
Yeah.
In blue collar-ish, Rust Belt, Main Street, completely. I mean, as non-sexy a story. If you had to like, what could I create as the non-sexiest story in banks? This would be it. And
Correct.
It's been a great company.
Great company, great stock over his career. Mm-hmm. He was also a master at acquisitions. And that's one of the traits, and we talked about Dimon before, the CEOs that don't do dilutive acquisitions, that seize the opportunity when these companies are cheap. The biggest, one of the best ones for M&C was Wilmington Trust. Got it pennies on the dollar. Fantastic acquisition. So I would put him there. The other guy, and we do it through the way the stocks have performed, he was one of these bankers, CEOs that crashed and burned in 1990. He was a phoenix that came in, John Canis from Norfolk Bank.
Norfolk Bank.
And he saw the handwriting on the wall back in 2005, sold the bank to Capital One before the blow-up came, and absolutely killed it.
Just a cute story. So I was at a dinner.
Yes.
I would say 2 weeks before John Canis sold Norfolk Bank to Capital One. Yep. I can't remember what it was, but I can tell you what the room looked like. And I'll never forget it. Somebody said to him, "John, don't you think you should sell the bank?" And with a completely straight face, he said, it was as strong as anybody could say something. There is no way that we are selling this bank. And then 2 weeks later, he sold. And I asked him years later, he goes, "It's a great price. What do you want me to do?"
Good poker face, that's for sure.
Unbelievable.
Yep.
Dwight?
Well, it's a good story how Bob took over M&T.
Yes.
He was doing investment banking at JP Morgan in Brussels, Belgium, where my dad was at the time. and he started building up shares in M&T, which was trading at like $3.
Right.
And he went hostile on it. And next thing you know, went from Brussels to Buffalo, and
Which is where
took
it's
it over.
based.
Yeah.
Oh, yeah.
I would say one of my favorites, and I continue to be so impressed by him, is Vlad Tenev of Robinhood.
Rob, really?
So when Robinhood was coming about, like
Why don't you tell everybody what Robinhood does? Because not everybody knows.
the upstart brokerage platform, essentially the fastest growing wealth management platform out there in the world. And it's been a great success story. And like many, I was highly skeptical of Robinhood when it first started. It's, you looked at Vlad as a tech bro rocking the black t-shirt like Steve is here today.
Thank you. Thank you.
And didn't know anything really kind of about financial markets, but he had this kind of cool app and he was going to disrupt the industry, so on and so forth. But what I've grown to appreciate with Vlad, and I've gotten a chance to sit in meetings with him, is a couple things what we talked about earlier. He surrounded himself with great people, right? He brought in to be a CFO, a senior executive from Amazon. He brought in people from LPLA or LPL Financial to run the brokerage business, and he surrounded himself with the talent to our discussion point around Jamie, right? He had the blind spots and he knew it. The ego didn't get in the way, and he brought in people to cover those blind spots.
What do you think his blind spots were?
I think he was a visionary, right? Very smart, mathematically
But not
gifted.
detail-oriented, maybe.
He didn't really know a ton about, obviously, the financial industry and everything that goes around it in the ecosystem.
Regulation.
Regulation, whatnot. He had a couple of hiccups. But the second trait that's really kind of impressed me is, and I think what all great CEOs do, right? The ability to see down the field. Right? Think of any great quarterback, Brady, whatnot. It's the ability to see down the field, see where the open receiver is, or see where the coverage is and where the gaps are. Vlad has that. And a great example being every company obviously got very fat and bloated post the COVID period. A lot of them came back to kind of choke on these expenses many years later when the economy kind of started to slow down. I mean, Vlad was probably one of the first companies to aggressively cut expenses, rein in all the hiring he had done. And it really kind of helped him ride through the 2022, 2023 period. And a chance for shareholders to be like, oh, this guy gets it. He knows what's happening. And it really kind of helped transform the shareholder base. And I think that's a big part of a lot of this too, right? Is getting the shareholders involved. It's not only the CEO for the ability to have, the people within the company kind of buy in, but it's also, all right, the chance for big shareholders to come in and say, you know what, I buy it. I'm bought into this too. And then they kind of pull back, my support, where we'll get to probably the crummy CEOs. It's when they stub the toe, it's kind of the oh shit moment.
So I wanted to talk about something that Jamie Dimon and Gorman had in common, which I thought is interesting, is that, after the financial crisis, the paradigm of how these businesses operated completely changed from underneath them. These companies went from 40 to 1 leverage to 15 to 1 leverage, so their ROEs were lower. They were told to de-risk. And, some, we'll talk about those who didn't make that change. But I think one of the hardest things for any CEO to do is to live through a period where the paradigm of his industry completely changes and adapt.
Right.
And I think Jamie and James Gorman did that. They should be applauded for that, because that
Absolutely.
is very, very difficult to do.
Very much so. Very difficult. And they did it extremely well.
They did it well.
Both of them.
All right, so let's move on. We went from the good, and we're going to go to the bad, and then we're going to do everything in the middle. So let me just introduce this a little bit. So I have this thought that, and we are going to talk about who's bad, but that sometimes there are good CEOs, there are mediocre CEOs, and there are bad CEOs. And sometimes if a CEO stays too long, he or she could be all three. And I'll just give one example of that. Hank Greenberg of AIG.
Yep.
So, Hank Greenberg, if you were in the 70s and 80s, Hank Greenberg was viewed as an incredible CEO. He built an incredible company at AIG. But the way he built it was very decentralized. So let's see, he'd want to do a new business. He'd say, go do it. And what I found out years later was because of decentralization, there literally were 200 operating systems within AIG. And at some point, it got so big, it couldn't be managed anymore. And that's when he got bad. So let's talk about bad. Give me a bad.
Every single thing you just said, you could replace AIG with Citi, no?
I was going to let somebody else do that.
if Jamie was the obvious gold standard, I feel like Citi, unfortunately,
well, Sandy Wiles is the same story as Hank Greenberg. Same story. He stayed too long. The business changed on him, and he couldn't adapt.
And I'd add one more important thing for Citi, because it set the stage for Chuck Prince to be holding the bag of maybe naming names on in terms of what went wrong, and it's taken now 2 decades for now Jane Fraser, CEO, to hopefully be starting to big
20
out.
years. Think about that.
It's
20 years.
It's incredible.
Yeah.
And it is, you can get put behind that 8 ball, right? Remember, the Citi diluted shareholders by about 90% surviving the crisis. So the problem is Sandy was all those great things that you mentioned, but then built a decentralized, massively global franchise. But
that he couldn't control.
But there might not be any such thing as global consumer, right? Different languages, different products, different cultures, different product preference. This isn't everything. And so you couldn't control it. And I remember this great. In 2005, they had a global consumer day. You were probably there, in Hong Kong. And that's when expenses didn't matter on the south side. So we all were there. And I remember—
They paid for your flight.
I'm sorry?
They paid for your flight?
No. Well, my firm paid, but they didn't care. So we're all there, and they spent like a couple of hours in the morning presenting their big global consumer franchise, how they, in 100 different countries, and have these global consumer banks, and they have like 1.5%, this 2% market share. And I remember to this day, Ron Temple at Lazard, who's still there, raises his hand and he says, okay, so it took you 100 years to get 2% market share in 100 countries. How long till you have scale and have any decent profitability? And the room went just silent because, and it turns
They didn't
out
think of it that way.
They didn't think of the integration, the profitability, the risk management systems, everything. And to this day, they're still trying to unwind it. They've been trying to sell or IPO Mexico, which is their biggest and best piece, for a couple of years now, right? So it's taken so long to pay for the mistakes of not integrating and not controlling the risk and not having your arms around it. Here we are, what are we, 17 years post-financial crisis, it's still among the very cheapest and lowest profitability banks.
What's interesting, and just to follow up on that, the reversal of fortunes, being one of the older sell-side analysts out there, we get a lot of the—
Not that old, Joe. Not that old.
A lot of the young kids. It makes him look like a kid. And so anyway, a lot of folks will call for me to help educate them on banking, and we got a call from a Toronto-based client, young kid, and he says, I think my Bloomberg machine's broken. I said, what are you talking about? He goes, well, I'm looking at the price to book of Citigroup versus JP Morgan back in 2000, and Citi is trading at 3 times book and JP Morgan's 75% of book. There's something wrong, right? No, they were the king of the hill before it
Right.
totally flip-flopped. But to your point, I would say when you think about some of the characteristics, what we've learned over the years, bankers that have concentrated risks in certain loan portfolios and grow those portfolios rapidly normally end up blowing up. And so when you think about Colonial Bank out of Alabama, Bobby Lauder was the CEO.
Nobody's thought about Colonial Bank of Alabama for a long time there, John. Long time.
we're talking-
Give us some lessons from Colonial Bank of Alabama.
So when you take a look at these banks back in those days that crashed and burned, the common characteristic was that balance sheets grew way too fast, no controls in place, and in high risk lending. That is a common trait of CEOs that crash and burn, and he was a good example of it.
Dwight, give me a bad guy.
I got a couple, but not that they're bad people.
No, not at all.
None of them are.
I think one of the things you always have to watch out for are the serial acquirers.
Yes.
I mean, our company's gone through 2 acquisitions. Those are hard, right? They're pretty gnarly. especially if you have complex systems in place that you have to kind of migrate or figure out what to do with. And to me, the serial acquirers are the ones that you have to keep an eye on. And to your point, Citigroup, it acquired a ton over the years, so at AIG. And there becomes a lot of baggage in these. And at some point, unless you're good operators, unless you can really integrate well, I think it's one of the things people always need to try to figure out is like who's integrating these transactions. There tend to be a lot of hidden risks in them. And we've seen it in the payment space where a number of these companies they've just blown themselves up.
So you got any names of any CEOs that you'd like to talk about?
Let's see. I mean, in the payment space in recent years, I mean, you've seen a handful of these. I mean, one of them was Nuvei, kind of a high flyer through COVID, serial acquirer. Things go haywire. Next thing you know, it's kind of on his butt. And there's been a number of these. Where at the time everyone's so excited around just the assets they're bringing on. And then it's not until you kind of go under the hood and you try to figure out how all the pieces are fitting together. And a lot of times within these companies too, I mean, the integration's really being handled by one or two people. And that's where you need to really figure out as a shareholder, I think, kind of like, all right, who's actually involved? Who's staying, what are the good pieces of the assets you're acquiring and who's staying involved to kind of help oversee, all the integration.
All right, so I'm going to bring up my Hall of Fame of bad CEOs. And I was trying to figure out, like, why was a decent guy, but why was this guy bad? It's Ken Lewis of B of A.
Yeah.
And, I mean, Bank of America did maybe two of the worst acquisitions in the history of mankind. They bought Countrywide Credit, and they bought Merrill Lynch. Now, Merrill Lynch today is a good acquisition, but it blew up their balance sheet. Countrywide, by the way, Countrywide, which was a mortgage company, B of A was like nowhere in mortgages. So they basically spent, I don't know how many billions of dollars on Countrywide, and it's effectively worthless. I used to joke about Countrywide that they paid for it twice. They paid the price, and then they paid for all the write-offs that they took on Countrywide was equal to the price. And I think sometimes you get CEOs who become CEOs because they were actually very good at political infighting. And that's how they get the job. But they're not, I don't know if the word is not the smartest in the world, or maybe, the skill set of being a good political infighter doesn't translate into being a good CEO. But that would be Ken Lewis. I mean, that's definitely my top 5 of bad CEOs.
Before you move on to your other Hall of Shame, Wall of Shame, very quick, funny Steve Eisman story related to that Merrill Lynch purchase is this was in the thick of banks and brokers disappearing out from under us, right? In the midst of the crisis in 2008. And sell-side analysts cover a lot of stuff. We had a regularly scheduled earnings preview ahead of the quarter that we'd normally say get
oh my God, he's going to tell this story. Go ahead.
50 or 75 clients to dial into would be good and normal. And so that's scheduled for Monday morning at, let's call it 11 a.m.
And what happened Sunday, Glenn?
So Sunday, it turns out that B of A, instead of waiting one day to buy Merrill Lynch for $0, decided to pay like $28 for it or whatever the number was.
That was Lehman Day. They did it on the same day that Lehman went under.
And that was the same day
that Sunday.
Lehman went under on Sunday, and they decided to make the announcement that they're buying Merrill Lynch for $28. And literally, they could wait an hour and they might have gotten it for free with a bunch of guarantees. So we were like, it seems a little silly. We're going to have our earnings preview. Fine, we'll do our earnings preview. Normally 50 people. 850 people dial into our conference call. I get on and I say, this seems a little silly for me to like go through what I think JP Morgan is going to do on the quarter. Let's just kind of open it up to Q&A. Let's have a discussion. And this is when you couldn't control anything. And the operator goes, our first question is coming from Steve Eisman from Front Point. And he's like, yeah, I have a question. I'm sorry. I did more due diligence on the underwear I'm wearing today than B of A did on Merrill Lynch.
I did say that.
And I just laughed out loud. I'm like, I'm sorry. Was there a question in there?
Was there a question?
There was no question. There was no question.
The other one on that acquisition, when they did Countrywide, when that news came across the tape, we were all shocked.
Everybody was shocked.
That they didn't get government assistance
Right.
because Countrywide was I mean, it was very clear it was failing. And for him to step in there and do that deal it was just
It's
shocking.
incomprehensible to me how he did that.
Yeah, I'm
More
with
than-
you.
Merrill Lynch, I could sort of understand that there is a real franchise there, and they didn't have enough time to do due diligence, and he didn't know how toxic the balance sheet was. Countrywide was clear, and they did it anyway. Anybody else you want to talk about?
Yeah, we talked the good side about asset management with Larry Fink and how that company is constantly evolving as much as just this year.
Mm-hmm.
I think the flip side, and I feel bad that I'm picking on one, but I think it's a great example. There's unfortunately many traditional asset managers that might fall into here, but the old management, not the current management of Franklin Templeton, ironically, same family, I'll describe. Franklin Templeton is one of many traditional asset managers that if you look at in the mid-1980s, only 5% of households owned a mutual fund. By the mid to late 1990s, 50% owned a mutual fund. So asset managers traded at 20.
Franklin was a great stock in the 90s.
Great stock, traded at 25 times earnings, was growing like a weed. And unfortunately, I'll fast forward, you blinked your eyes and the industry had more mutual funds than there were stocks. Crazy statistic. Fees were high. Performance was very hard to keep up with. And then technology came for the business, just like it comes for every business eventually. And you can replicate in a passive index and eventually an ETF for 3 basis points. And then, so every year now we have $300 billion of outflows of mutual funds and 300 into ETFs. And too many asset managers just sat around and counted their money and were fat and happy and failed to evolve. And so for 15 years, that company paid big dividends, and then they paid special dividends, and then they did buybacks because their stock was
It was
cheap.
a family-run company.
They owned
Johnson
a
family.
little more than a third of the company.
Yeah, but they controlled it.
They controlled it, but they were busy paying 11 grandkids dividends and special dividends and doing buybacks to help the share price, and unfortunately failed to evolve. And you blink your eyes, and all of a sudden, what's growing in the world? It's ETFs, it's SMAs, it's actively managed ETFs, and it's every flavor of private markets, and it's the long, short, hedge fund, multi-strat platforms. And they have none. Now, today, ironically, the father passed the business down to the brother, who eventually the sister took over, the daughter took over, Jenny Johnson today.
And she's good.
And she's really good.
Oh, really?
And
Interesting.
she's doing everything that I describe BlackRock is doing. Hasn't yet fully helped the stock price. It's a long haul. It's in motion. And she uses her cash flow to make the company better.
You got anybody else you want to mention?
I would just say in general, coming back to the characteristics of banks that are not well run, the concentration of risk and the rapid growth. And the landscape is littered with failed banks. And you look at the Texas banks in the 80s, the Northeast banks in the 90s. And then we go through our financial crisis and you have Washington Mutual, Kelly Killinger. I mean, oh my God, how do you blow that thing up? And these guys,
managed.
yes, and so again, these are not bad people, but they just were not very good at running these companies. And again, that common trait is rapid growth in high risk assets with little controls. And when the downturn comes in, we're a cyclical economy. We're always going to have downturns, and that's when the fortress balance sheet guys, M&T,
Like Jamie.
J.P. Morgan,
Right.
That's when they shine.
They shine.
Absolutely
You got anybody
shine.
else you want to mention?
Yeah, I do. One more. I was a young investor at the time during the GFC, and how can you not bring up Lehman? And I think one of the things that jumped out to me that kind of after the fact, when there was a ton of articles and books, of course, written on it, was the composition of the board, right? And this was a big point that was kind of brought up a lot on Lehman, where Dick Fold, the CEO of Lehman at the time, a bunch of yes people. And largely,
Oh, I think it was actually much worse than just yes people. I think
they were in their mid-80s.
But they were people who, most of whom had no background in financial services.
And yeah, that stuck with me. And it's something that it's hard from the outside to really evaluate and try to figure out how good these people are and how involved they are. But I just remember that always sticking with me. Like the average age of the board at Lehman at the time was like 86, 87. To Steve's point, many of them had no outside knowledge of financials. And so, of course, like when midnight comes and there's a crisis, like where's he getting that kind of solid advice from?
Such a great point on the board. That's until something bad happens, the light doesn't get shone on that. And now, I'll speak at different board offsites, and you go look at the composition of companies' boards. They're definitely better, but you can see who has a friend group versus someone that brings competencies to each part of the company. And I would say one more thing about Dick Fuld, because Lehman was actually a phenomenal firm in many ways, but one of the things that we all discovered in hindsight was we were all scared shitless of him, and so were his direct reports.
So were his people.
And so the commercial real estate book grew too big, so the story goes, it was too late when it was finally eventually presented to him. And so there's some fatal flaw in that management process.
That same thing happened with this Bobby Lauder, Colonial Bancorp. Everybody referred to him.
They were scared.
Yeah, everybody referred to him as Mr. Lauder, his direct reports. And that was always a red flag whenever you heard that, oh my gosh, what's going on there? So that is definitely so. But coming back to the boards more recently, Silicon Valley. You look at that failure in 23, and to Dwight's point, look at the board makeup there. There weren't many financial people on that board.
They're probably tech people.
Tech, but also a lot of the ESG stuff. It was very popular then, and that was the other.
I want to change gears because I want to bring up a variation on the same thing. Can you name a CEO who you once thought was really good, and then years later, when you look back on it, you say to yourself, "Changed my mind"?
I think one of the people that fit that description is Dick Kovacevic at Wells Fargo. I mean, he for years we all thought he was.
For the viewers who don't know, so Dick Kovacevic was the CEO of Norwest,
Correct.
and apparently did a great job.
Yeah. Oh, yeah. Very much so.
And then he bought out Wells Fargo, which was. Norwest was considered a big bank, but not a great, not a famous bank. And he bought out this bank, Wells Fargo, one of the most famous banks in the country, and renamed it Wells Fargo. And he was worshipped. People thought he was one of the greatest CEOs. Tell us what happened.
Yeah. And so he was the orchestrator of the cross-selling, and everybody was so envious of Wells Fargo's ability to cross-sell. And so he instilled that culture into the bank, which eventually, in 2018...
After he was gone.
Oh, after he was gone, it blew up dramatically.
I think it's actually worse than just cross-selling. I think it's also that he's another example of a CEO who liked a decentralized structure.
Oh, yes. That was...
And so people ran their divisions like independent businesses, but there was no real oversight of people doing bad stuff until it was way too late. And that could be laid at his feet.
Yep. The other thing with him, in my belief, unlike Fleet Financial, when you put a sell on it, now we're going to put you in front of the fax line, he was very critical of the sell side. I mean, he had, in my opinion, thin skin, and that did not go over well either.
Mm. You got anybody? What?
Yeah, I would say probably the old predecessors at Schwab, where we always thought of Schwab as this untouchable, remarkable company. And there's a couple things that I think have come up in recent years, and where it's not until things kind of go wrong where you take a step back and think around, like, did I have it wrong on this company? And for Schwab,
what turned out to be wrong at Schwab?
I think for Schwab, there's a couple of things that, and it goes back to some of our earlier discussion around kind of just communication with shareholders. Yeah, with Schwab, they always did this thing, right, where they put out earnings, but they wouldn't host a call. And you had, I think, a spring update call and a fall update call. So twice a year was a chance to kind of, get some pointers. It was largely a scripted event with maybe some questions that would come up at the end. You would never see them on the road at conferences. They hardly did NDRs. But for the most part, shareholders were all right with that. Hey, it's a great company, good growth. One of the bellwethers within financials. And then you fast forward to 2023, we had the ups with the
Tell them what the ups
interest
was.
rates and the balance sheet, the long duration securities portfolio. And basically it was on the brink. I mean, it was arguably going to be one of the others besides Silicon Valley and
Why do you
First
think they
Republic.
survived?
The Fed. And it's really
So
one
they
of those,
did the same thing in Silicon Valley. They bought a whole bunch of long duration bonds, and when the rates went up, they were underwater.
Yeah, and I think it's one of those events where you look back on it and, and again, you get reward with good management teams that are very upfront, very honest, very open. There's a trust factor there with shareholders, and it's those events where, if they need to raise capital immediately, everyone's all in. And I think there became a question around like, all right, where has this company been? Why haven't they been open on this? And any kind of critique had come out in the press, in articles. They were very much, on the front foot, pushing back against a lot of this stuff.
I think the whoops was asset liability management.
There's a lot of whoops,
and an
but yeah.
amazing broker-dealer that owned a bank that you blinked your eyes and it became a bank that owned a broker-dealer, and they mismanaged that risk, right?
Yeah.
So but the difference between them and every other bank that's been mentioned already is their customers never left. The business they've built is insane.
Right.
Yeah, that's a good point. I mean, there's a difference between the customers and the shareholders, right?
Correct.
And I think in this case, there was really significant kind of erosion of trust. And again, one of those things, you take a step back and you look back on it, and it's like, did my perception of the company change? And what have they done since then? They have earnings calls now, right? They're much more open. There's a lot more communication. And I think, they learned, and they have a new CEO in place.
Yep.
What do you got, Glenn?
I think that same period of time, Ron Logue and Bob Kelly ran State Street and Bank of New York. They were trust and custody banks. Gerard knows them well. They were viewed by the world as super safe, conservative, steady eddies.
Right. Never have to worry about them.
And you blinked your eyes, and they both were a minute away from disappearing.
Because
it turns out those two ran levered bond funds for balance sheets, and they didn't know it, for the same reasons that you shone the light on. The mortgage securities that they owned extended, lost a lot of money. Their liabilities can't be controlled, so people can pull them out overnight. All of a sudden they had these long-dated, not as worthy mortgages, and they had some failed capital raises. Like they almost both went out.
what year was this?
During the crisis.
During the crisis.
Yeah, right in the crisis. And so I feel like, I don't know if either one of them were viewed as the rock star status. They weren't. But they were viewed as conservative, stable companies that you own when times are tough. And they were anything but that when times were tough.
All right, so I got one that's so obvious to me. Lloyd Blankfein. I think perhaps one of the most overrated CEOs in our industry. So during the good times, he was viewed as great. The high ROE, and
CEO of Goldman.
CEO of Goldman.
Yeah.
Okay.
The old CEO.
And thank you. And I think the first chink in the armor, other than just the general crisis, because they actually came through the crisis much better than others, because they actually shorted a whole bunch of subprime paper on their clients. Wasn't so nice. But one of the interesting things, I would say the first chink in his armor was there was an article written after the crisis by Gretchen Morgenson.
Oh, sure.
And it was a fabulous article. And she described how Goldman had this culture that was client-centric. And going way back, it was something like the 14 principles of Goldman Sachs, and all the principles were be for the client, be for the client, be for the client. And Lloyd, who came from a trading background, she said, had created a 15th principle, which was basically overcame all the other 14 principles. And the 15th principle was everybody's a counterparty. And I actually think he harmed the culture of Goldman by in that way. And in fact, I remember a few years ago at Neuberger, I was at a meeting with, what's the name of the current CEO?
Solomon.
David Solomon was at the meeting. And he basically admitted that in the meeting that he was trying to get Goldman back to its client-centric roots. And I was kind of shocked that he would admit that. But I think the other thing that, just unlike James Gorman, who in the paradigm shift, really was able to adapt everything Lloyd did to adapt. First of all, I don't think his heart was in it. And every decision he made, I mean, tell us a little bit, you know the details better than me. Tell us some of the things that Lloyd Blankfein did to try and adapt to the new environment and what happened.
Well, before I drag him through the mud with you, I would say sometimes the best thing a CEO can do is not mess up the best part of our organization, right?
Right.
Charlie Scharf had a cup of coffee at Visa, and I didn't cover Visa, so I can fit in a thimble what I know about it. But that was an amazing company when he got there, and it was an amazing company when he left.
He didn't screw it up.
And that's an accomplishment. And Goldman's investment banking franchise is still among the very best on the planet Earth. And
True.
he kept that.
Yes, that's fair.
And their trading platform, now to your point, who is your counterparty? Were you facilitating trade or were you taking risk? I think he was slow to adapt to the regulatory environment of stop using your balance sheet. We're going to tax you a lot on that, and don't be.
In other words, after the crisis, he didn't recognize that the capital requirements were now such that he couldn't do what he always had done.
Right, and so there's pieces there.
By the way, it's very hard for anybody if something works for you for a very, very long time and all of a sudden the rules change. That's a very difficult thing to adapt to.
Look at you doing a podcast.
I guess so.
So I think David Solomon gets a lot of heat for growing the consumer business and sticking with
But
it.
before you get there, just tell us what Lloyd tried to do. Some of the business that he tried to do. What happened?
Today, they're still trying to unwind the on-balance sheet. They call it historical principal investments, but he basically had a private equity and private credit book on their platform, which was genius, but took the wrong form. They did it with their dollars on balance sheet, was capital intensive, and
they should have used third-party capital.
Heavy. And if they did third-party capital, they would have Blackstone inside right now.
Right.
It was completely correct, and they went for the 100 cents on the dollar, but capital-intensive side instead of getting 2 and 20.
And that would have been, if he had done that, that would have been the diversification of Goldman Sachs.
Yes, and by the way, it's amazing. They're halfway there still, though, because they're not bad. They've now reoriented the company to focus on improving asset wealth.
For the viewers, just to tell them what some of the consumer businesses that Goldman tried to do to diversify the business.
Well, the first part was actually okay. Goldman Sachs has historically, they don't have a bank, right? They don't have a retail bank. So they were jealous, as they should be, of all the banks that have low cost of funds consumer deposits. They're like, we want that. And they bought GE's deposit platform, online deposit taking platform, which was actually great. What they chose to do with those deposits, not as great. So they said, okay, we got these deposits, let's go make loans. And so they did a series of things to grow their lending business through what they called Marcus. Again, the deposit side good, loan side bad, and then build a credit card business that, were it not for the accounting and the regulatory treatment, it's not the worst idea. It's a high ROE business, and they got the best first client on the planet Earth in Apple, except the way the accounting changed, it made it horrible for Goldman Sachs to be the owner of that and try to start from scratch.
What do you mean the way the accounting changed?
Well, the way the accounting changed is you must take your whatever you think the losses of a loan
and take it all up front.
Take it all up front.
Right.
So it's another way to say that is you take all your expenses now and then you make your revenue later. And in good times, or if you have scale in that business, that's fine.
Right.
If you're just starting the business, you look like you're losing gazillions of dollars every day.
Right.
And people that love you for your investment banking, your trading, just punch you in the face every day.
Why are you doing this?
Yeah.
One other name that also kind of was at one time considered a very strong CEO and then unfortunately ended up not so much is Ken Thompson at Wachovia.
Yes.
So Wachovia, what legacy Wachovia merged with First Union, and he eventually took over the combined companies. And he
did a pretty good job.
Oh yeah,
He ran the bank very well.
Oh yeah,
and then he made an acquisition that was. Tell us about the acquisition that wasn't so special. He did, and you know what the funny thing is, this happens to see us. He made his shareholders saying, "Do an acquisition, do an acquisition." I'm not going to do an acquisition, and he kept pushing back. And finally, he gave in and tell us what acquisition he did.
He bought this large thrift out in the West Coast.
What was the name of it?
Golden West.
Golden West, yes.
The Sandlers, I believe. Ran
Yes.
that. And
Herb Sandler.
Herb
right?
Sandler.
Yes, and they did a very good job with it. I mean, they made quite a bit of
And
money.
that sank the bank.
Absolutely, because
Yeah.
that was the no doc,
So
no doc.
I have a great
Yep.
Herb Sandler. So
Yep.
Herb Sandler's brother was once my father's best friend.
Okay.
So the Sandlers actually knew me when I was in diapers. So on the day that Wachovia bought Golden West,
Yes.
I was like, okay, that's the gong for the crisis.
yes.
Because if Herb and Marion Sandler of Golden West are selling their company, you know the mortgage
Yes.
market is over.
Yes, correct.
And so Vincent and I went to this hotel in New York we went through the whole presentation. I think I brought like a novel to read because I had no interest at all in what they were talking about. And so we were just sitting in the back, and Vincent and I waited until literally almost everybody left. And I walked up to Herb Sandler, and I swear to God I did this. I gave him a hug and a kiss, and I said, Herbie, top ticked that mortgage market, didn't you? And he looked at me. He was such a tough son of a bitch. He looked at me with a totally straight face, and he said, I don't know what you're talking about. I think this is a great deal. And I said, okay, see you later.
Yeah, but that was probably one of the best all-time sales.
Of all time.
You know, Canis did great with
Yes.
Norfolk as
No,
well.
that had to be the
But I
best.
think Golden West may have been the top
The
tick.
best sale and
Yeah.
one of the worst purchases ever.
Absolutely. And then after they bought it, they kept running with that product. I mean, that low doc, no doc product.
Yeah.
Which, if it was done properly, because Greenpoint Savings here in New York was the one that I believe originated that product. And if you had the loan to values at 40 and 50%, you ran with higher delinquencies, but you didn't run into credit losses
Right.
because you had the collateral. But the Wachovia went up to 80, 90% loan. It's just a disaster. Disaster.
All right. I have nothing else to say. Anybody else got any final thoughts?
You want to flip the script on this conversation
Sure.
and say, who did you think was bad that actually, in hindsight,
was good.
got better?
That's interesting. I raised a question. I haven't come up with anybody. Do you have somebody?
I have someone,
Okay, who's that?
Brian Moynihan. Brian
Oh.
Moynihan in 2008,
Yes. I like that.
they took their lumps and they were
so tell
not the
everybody who Brian Moynihan is.
was and is the current chairman and CEO of Bank of America.
After Ken Lewis, who we spoke about.
After Ken Lewis, who we're all not big fans of.
Right.
And Brian inherited
A bad situation.
a bad sitch, and he took the 10-year overnight success story of slowly but surely making that company a little bit better and making tough long-term decisions. And in the early years, I think I and lots of people were like, this company stinks, that guy stinks. And,
Right.
and like we
But he fixed it.
he
really
he
did.
truly
He
fixed it.
You know
and
what I
it's
admire?
an
One thing I admire him.
excellent company
Yes.
that grows, that invests, that earns.
He had
It's
the
not
guts.
perfect.
He had the guts when he took over to say to the street, I am providing no guidance for something like 5 years. It's
Yeah.
going to take me at least 5 years to fix this
Yeah.
puppy. And in 5 years from now, I'll talk to you. And it took him 5 years to be able to
and I couldn't
show
appreciate it. I couldn't appreciate with hindsight, I can appreciate it. And you look now, and they open new branches and markets and take share, and they invest a little at a time. People want them to invest at a faster pace. They made one mistake when rates were zero, but
manageable.
they've done so many good things under his leadership, and that was the turn. That was the turn.
And he came from the Fleet Boston acquisition that Ken Lewis did when they bought Fleet Boston. But he was on his way out, to Glenn's point, back in 2008 when he was kind of put off to pasture, and then Ken Lewis blew up, and then they brought him
And
back.
then you're like, how's this lawyer going to come in
He
and
was a
run
lawyer.
this
How's he
bank?
gonna run this bank?
And at
But
first,
he did.
He seemed like a lawyer running a bank. And
Right.
he just got better each year.
And we talked about it earlier about CEOs that know their numbers. Him and Jamie Dimon, for two enormous organizations, know their numbers. And I tell you, Brian Moynihan, I think, knows them better than Dimon. I mean, Dimon knows his numbers very well. But my gosh, you get Moynihan at a table like this, the guy is incredible. Not the best public speaker. Everybody knows that. But boy, sitting around a table, I'd take him. He is quite phenomenal.
I'll give you one more.
Okay.
And you actually brought him up earlier as a good CEO, but I think there was questions at the time when he took over, Mark Rowan.
Yeah.
So Mark Rowan,
CEO
at
of
Apollo,
Apollo.
took over at a time where there was a lot of questions on Apollo. Leon Black, the former CEO,
Little scandal.
The scandal. No one really quite knew who Mark Rowan was. Obviously, they knew he was one of the founders. He wasn't as well known to the street. He was the architect behind building or the acquisition and built in the building of Athene, which is the insurance company that they ended up bringing in-house and owning. But there's a lot of questions around just what the direction of Apollo, where it was going, what was his communication style going to be. But he's been fantastic. And it's really, he's a visionary. He's, almost kind of Jamie Dimon-like in his presence and how
thoughtful.
He's thoughtful.
Very thoughtful.
And
insightful.
7 steps ahead.
Yeah.
And he commands the crowd. I mean, people really buy into kind of every word he says, and he's turned out to be one of the best things ever for Apollo.
Let's tie these together. Your Goldman discussion, okay? When Goldman Sachs decided, hey, there's this huge TAM over here that we don't touch called consumer banking, maybe we should do that. And they have 400 partners at the time, and I think 2 or 3 sat in the consumer business, and the other 397 were like, no! And every shareholder in the world was like, no! And they're like, okay, cool, we'll do it, right? And so they did that. Notice what every investment bank on the planet didn't do. They didn't copy them, right? When Mark Rowan took over and his first order of business was to buy in the insurance company that was trading at like 6.5 times earnings.
If that.
And everybody was like, what the hell are you doing? Insurance companies trade at 7 times. Like, why would you do that? The private markets is great. Notice what's happened every
Everybody's
day
followed
for the
him.
last 4 or 5 years. They're dying to recreate what he's built on origination platforms, on a private credit platform, and everything he predicted is happening, and it's unbelievable. So that's, and then you didn't. We touched on it earlier, but how he's changed the culture of that firm.
Oh, for sure.
It is one team. It is incredible to watch the transformation of that
I've
company.
heard
That's one man.
Before him, it was very much a lot of infighting. People didn't like each other. It was a difficult place
That's
to
kind of
work.
what I mean. It was when he took over, there was a time around like, who is this guy really? Can he
Right.
turn around? And
No, he's
we just
done a good
highlighted
job.
just what a great job he's done.
Yeah.
And one final thought is that when you look at the measurement of success, and we use J.P. Morgan obviously as one of the real pinnacles, Dimon in his shareholder letter every year talks about how he grows his tangible book value per share and dividends per share every single year. And when you take that out over 10, 15 years, J.P. Morgan's right at the top of the list, along with P&C, who we really haven't talked about much. But the companies that focus on creating shareholder value through tangible book value per share growth come out on top all the time. And Morgan is one of the best at doing that.
Here's a plug for your future podcast. They're great leaders produce future leaders, right? And one of the things that people always like to talk about is who's taking over for J.P. Morgan if Jamie ever decides to hang it up. If Jamie wasn't Jamie, Marianne Lake would be Jamie. I remember the first day I met her. She was some CFO in one of the business units that took over, and she became CFO. I hosted her first meeting. Never really heard of her before. And 2 minutes into the meeting, I turned to my associate. I'm like, where did this woman come from? Like, she is everything you just said. Beyond impressive, knows every number about every business, and is fit in the mold of Jamie and bleeds J.P. Morgan. And to the point where, this is the biggest and broad, this company has 6 or 7 huge businesses inside that could be separate companies. And one day they just decided, hey, why don't you do the whole investor day? And she just sat there and talked at us for 8 hours and knows everything about everything.
That's incredible.
Wait till you see her. She will be the next.
Okay. Guys, that was great.
Thank you.
It was really enjoyable.
Yep,
That was
same here.
really good.
Thank you.
Thanks, Frank. Thanks for showing up here and telling us what you think.
Always.
Thank you.
Very good. Thank you.
Thank you. This This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.